Ja, hallo meine Damen und Herren. Es freut mich ganz besonders, heute Herrn Guido Fürer von der Swiss Re zu begrüßen. Er ist verantwortlich dort für nachhaltiges Investieren. Und obwohl er einen Doktortitel in Risk Management hat, ist er dort der Investment Officer, weil es ihm einfach auch mehr Spaß macht, hier die Risiken einzugehen, als sie nur zu vermeiden. Dear ladies and gentlemen, international audience, here we have the investment officer from Swiss Re. He is in the financial risk management. Formerly, he has a PhD, but now he really also not only wants to avoid risk, he also wants to invest and gets into good investments. And he will talk to us about how to connect sustainability with investments, how ESG investments look like, and what is the role of leadership in finance? How can we transform the financial industry to be making more impact to the ESG goals, and also about how to get net zero and also how to handle social and environmental responsible investments. The floor is now to you, Mr. Führer. We are very much looking forward to your presentation.
Thank you very much. Thank you very much for the introduction, but also thank you very much for having me. The title is a big one, no doubt. Responsible investing now more than ever, and I'm sure I owe you an answer why it should be more important now than it was before. I want to share one slide with you. Hopefully, you can see it on the screen, because I quickly wanted to show what it means in respect of what the thematic impact is, which we all experienced. And you basically are confronted with a sell-off in every respect. And I think that the picture which you see here is very symbolic, in the sense of that's a freeway in Texas during the lockdown, and incredible that such a picture exists at all, but it's symbolic what we've all experienced. The few graphs show you things have basically changed. You see these are purchase manager index, which are very good economic kind of indicator how things are going and how things basically evolve. And you see huge sell-off, huge turn down, and you also see some recovery since then. One of the graph basically shows China, which is ahead. You see the light blue line, which shows a slightly different picture. Overall, the economic growth declined in Q2 9.8% in respect of GDP, and that's a huge figure. And just to put it in contrast, probably many of us still have the great financial market crisis in our mind in 08, 09. The drop at that point in time was just literally 2.3%, which is basically a quarter what we experienced this year. That's why it's in every respect unprecedented. Now let me move to the message why now is a very good time to think about. And one reason for that is clearly flows, just the sheer size. And starting with the public sector. Public sector, basically, or the governments support economic growth right now, and the estimate comes from McKinsey, is about the 10 trillion package and stimulus package which we see. That's unprecedented. Again, the figure for the time when we had the great financial market crisis was about 10 times smaller. And of course, flows means these are opportunities to redirect some of the money. And I think the flow was so huge. That's why the time right now to think how we can improve the sustainability of market, but also of society at large. It's a unique point in time. This is clearly one reason. The other reason also, on that, I know I need to show you a bit more as evidence. To invest responsible or sustainable doesn't mean that you have suffer returns necessary. It's rather the opposite. And the other reason why I think it's a perfect time is you see the interest just from the investor community, and you see on this slide the headline figure of 1 trillion. Right now we have ESG, and ESG stands for environment, social, and governance funds. Altogether, they manage approximately 1 trillion, which is again a huge figure. By the way, this is this area, ESG investing, is by far the area with the highest growth at the moment. Even in the last few months and the last 2 quarters where we had huge turmoil, that piece still worked. And I took as a reference a Goldman Sachs study, and that study shows that the year-to-date ESG funds were positive by 87 million net, whereas we had outflows of traditional funds. And we're going to take the broad equity funds, they experienced a net outflow of 123 billion. That means even in extreme stress, as we had the last 2 quarters, you still saw negative, basically positive flows in the ESG, but negative in the traditional. It's another indicator for huge flows which are currently going on. But these are just a few examples, and the reason why I believe this ESG or the responsible investing matters. Investors start to think, okay, what else is important for the long-term stability of financial markets? Of course, if you have that context, it's very clear that this is a different criteria coming in. But you also see the interest for millennials, and we know millennials is basically the generation which takes over, that has already taken over management of many funds. And I'm still part of the baby boomer, but I know time is fading, and I will be replaced sooner or later by millennials, and they have a completely different preference for ESGs. And ESG right now, 95% of them favor such type of investment style. We also heard about this stakeholder capitalism, and before we talked a bit in the former session about sustainable, responsible leadership. And it's a clear rethink going on that it's not only shareholders which are important, no doubt they remain important, but not only. We have others like clients, we have also employee, but also society at large. And of course, if you apply different set of criteria, you start to think, okay, how I can best meet those expectations. I think that's another reason why I think the timing is really perfect. Now let me move to basically to the company which received these funds. With other words, ESG funds or investments which are driven towards the sustainability. And this is just a picture which should express what is relevant. So each company has an interest to basically fund as cheap or as low as possible. Now on the graph you see a so-called triple B company. Triple B is a credit rating. It shows the credit worthiness of a company. Now a company can vary in respect of the sustainable footprint. So triple B from a credit point of view can do a lot for stakeholders, for environment, etc. That's why such a company will have a higher rating in respect of ESG. On this graph I show different ESG rating. That means credit rating is stable, but certain companies, they do much more to produce more sustainability, more sustainable and other things. And you see the big difference which is presented on the y-axis, on the horizontal, in respect of costing. On this graph you see a triple A company in respect of ESG rating. The funding is close to 120 basis points. If you go on the other extreme, that means the company does not really care about ESG. That's why it probably will have rather a lower rating. Let's say it's a B rating. The funding cost will be 180 basis points. You see, ESG only makes sense from an investee or basically borrower point of view. And the higher, of course, the preference is expressed by investor, the more this becomes true. That means a high ESG rating doesn't mean just doing good, but those invest a lot into sustainability. It also should pay back via more attractive or lower funding cost. But probably you expect something from me from an investor point of view. Again, Swiss Re, we are a reinsurance company, but also we are a big investor. And there are many stats which show that responsible investing actually pays out. And the very recent one is BlackRock published just the latest research, and it shows that in the last few months that 88% of the so-called sustainable fund outperformed the non-sustainable fund. And you have many other things, but I wanted to share also my own experience. And you see this on the graph. This basically shows the outperformance of what do you see here? Let me quickly switch to this graph. Yeah, very good. Here you see the outperformance what we experience in our own equity portfolio, and it's enormous to see. That's a cumulative return, and there's almost no time between this June 2015 and now where so-called an ESG equity portfolio underperformed. Most of the time it did outperform, and also more recently, and I'm talking about basically the last 2 quarters of this year, in our own equity portfolio, which is 100% ESG focused, I could show an outperformance of 1.4% over a non-ESG portfolio, and that this is big. And you hear a lot of comments which say, okay, that outperformance in the last 6 months was mainly due to low oil price. That means some of the oil producer, they had, of course, particular challenging environment. But that's not the main reason for the outperformance which I observe in my portfolio, because the so-called capital weight of those energy companies or of the sector itself is identical with the non-ESG benchmark family. That means we didn't reduce the sector allocation, but even in spite of not reducing it, we see a completely different performance, and that's why it's really linked to the ESG, not necessarily just to the low oil price. And this gives you a few examples, and ultimately it's the outperformance, but what probably everyone would expect, it's a much safer portfolio. That means less downside risk, and that's why you also come to the conclusion sustainable investing is much better from a risk-adjusted point of view, clearly much more attractive. Now, ESG consists out of 3 letters. As mentioned, this is environment, this is social, this is governance, and probably it shouldn't be a surprise that environment, and particularly the climate piece, is very close to our heart. Again, Swiss Re is a reinsurance company, and our sector is particularly exposed to weather or climate more broadly. And it's also clear that the last decade between 2010 and 2009 was the warmest ever since we measure temperature. And this is also observable in the graph. If you look at the bar chart, the blue one, you see a constant increase. That means also the last 10 years, where we have a clear increase in temperature, we had a much higher number of events, insurance events, which were weather related. But it's not only the number of events. You see also that's basically the line, the blue line on this picture. It's also trending upwards, and that's the loss. This is the size of the insured loss, basically what we pay out as a sector, as an industry, and that is also going up. No wonder we have more areas which are exposed to kind of global warming, climate risk. There's more concentration of certain assets, and of course, if something happens, the damage and the insured loss is going up. That's why, as a company, but also a sector, we have a high interest in climate-related aspect, and not only on the kind of product offering, not only on the insurance side, but also we translate it into the asset side. Again, we are all investor. That means we invest the premium which we receive or the reserve which we put aside for paying future claims, and during that time we can do a big difference. That's why we decided to switch to ESG and making sure that we also can address some interest through the investor kind of lens. And if you allow me, I quickly give you an overview how we approach this. And in Swiss Re, we are basically almost 100% ESG focused on the asset side. And the different way to express this, the most meaningful one was that we switched benchmark about 3 years ago. That means we replaced all former benchmark, which were more kind of commercial, more traditional, by so-called ESG benchmark. That means I measure my portfolio managers or any external manager which we have basically under contract, measure under an ESG criteria, and then decide it was outperformance or underperformance. This has a huge impact in the preference of certain security, and of course is directly expressed in the portfolio composition. That's probably was the most meaningful step. We also have so-called thematic investment, which many have, such as kind of we have a renewable portfolio or we have a green bond, but usually these are just a few percentage of the overall allocation. That's why the benchmark ultimately drives the big differentiation. You have also exclusion. That means you don't invest into certain companies anymore, and this is always the toughest and the harshest, of course, way to express investor preferences. And you only do this if you really believe something will not change and something is really directly jeopardizing any ESG kind of goals. Ultimately, you want to give the society and the companies time to transition, and each transition needs funding. That's why our interest is to find the most attractive companies who are willing to adhere to a different set of criteria, which are best expressed by ESG. Now, we also started to constantly share our learnings. Again, we were, I think, the first insurance company globally which completely switched to ESG, almost 100%. But there's a lot of things which is not perfect, and that's why we try to show what has worked, what has not worked. And just the last 6 months gave us new insights. And basically, to quickly want to summarize this, we have ESG benchmark, and the main reason why we outperformed is not that we try to pick the best ESG kind of companies and the highest rating one, but that we avoid the kind of the worst companies backed off pollution, but also social and governance kind of massive deficits. That means avoiding the worst seems to lead to the biggest outperformance and not necessarily pick the strongest one. And these are learnings which you do through implementation and also try to analyze from where kind of gains and losses are coming. I think another figures which I wanted to share with you, since we switched benchmark, again, this was about 3 years ago, we could cut the so-called CO2 or the carbon footprint by half, basically almost 50% in our portfolio. That means the companies which we currently have invested in have a massively lower contribution or pollution to CO2. And this can be expressed in tons of CO2 per million revenue, the different measures, but the carbon intensity reduction is massively. And this is mainly thanks to change in benchmark. And that's why it really makes a difference. Now, to share this and to be engaged, we also decided to co-found a so-called Asset Owner Alliance together with United Nations. And there we basically are a number of institutional investors which have basically committed to reach a net zero carbon portfolio, investment portfolio by 2050. That's quite a long time. On the other hand, it's a super ambitious target. I mentioned we halved it in the last 3 years, but to reach basically net zero is a tough one. But we committed to that because we believe we have to make the difference and we can contribute through investment. But also as a company, we also signed the United Nations Business Ambition for 1.5 degrees pledge. That means it's not only the asset side of the house, but we as a company, we believe we have to pay and do our part of the journey to make the world more sustainable. But I think that's probably not enough. There's a lot to learn. And it's anything than perfect. And probably you could ask me, what do I mean with responsible investing? And probably I could give you 10 different definitions. You could ask me, what does it mean, ESG investing? How is it exactly measured? And no wonder it's still in the making. There's no kind of world standard. It's not 100% clear how companies should report on their ESG footprint and improvement. That shows it's very fragmented. It shouldn't be an excuse to start. For us, this is more invite to be engaged. Again, we try to engage also with policymaker. Again, Swiss Re has been asked to join the EU technical expert group to define what an ESG benchmark would look like. These are things which should help to make it more standardized, to make it easier for others to join. But also we try to engage a thought leader. That's why Also this Asset Owner Alliance, which we co-founded, is another example. Together with similar thinking institutional investors, we try to engage with the companies. We try to find an optimal way to transition to make the world more sustainable. And you do this best in dialogue, because again, exclude or just divest should be always the last, I guess, answer. There are many better ones, and basically help companies to keep jobs but make it more sustainable. That's why this thought leadership is very important, ultimately to promote what we are doing. And I think that's another example today, just to share how we can improve things and how we can contribute to a more sustainable world. And I come back to my message, which I started with. I think now more than ever, and again, I believe responsible investing will not disappear as a topic. It's rather the opposite. It will stay based on the huge interest which we see, and also because of the flows which are currently, I think, finding a home and can be directed to the right value chain. And that's why I believe it's super important to show what can be done in a relatively short period of time. Let me quickly pause here and see if there's any question which came up. I'm not sure, René, if you have anything at your end which you want to raise before we kind of go to. Thank you.
Thank you, Mr. Fürer. I think it was a very lively example how the investment paradigms are changing right now, overcoming the old trade-off thinking between profit and sustainability, integrating ESG. Is there any particular point in history where you really made this shift of thinking, this new thoughts? When did it come into being? Because 10, 20 years ago, not many people were thinking this way. Now more and more investors like yourself are going in a new direction, I would call it. Is there any particular event in the past where this mind shift happened?
I have to say, probably as a reinsurance company, you are closer to some of the big trends. And again, in Swiss Re, the whole climate change is a big topic for us. Actually, it was in the late 70s when we published our first report on climate risk. And that's why, I guess, being the biggest NatCat reinsurer globally, we are probably more closer to this topic. And I think the challenge which I faced was how I translate this into the asset side of the balance sheet. I think on the insurance side, of course, you try to steer that exposure through pricing certain items or reduce capacity or increase it. But that's really pretty much the way how you steer the insurance business. The challenge was how I can make a difference on the asset side. But we felt that's a long-term trend. When you have all the proof on the science, this is not something which is just a one-off, this global warming. And that's why we should have an interest to take this as a big trend or as a big theme. And then we were brainstorming how express this. And of course, we started with, let's start investing green bonds and kind of renewables relatively early. And that's good. And we allocated a few percentage of the portfolio, but we couldn't make the real difference. And that's why financial market on each portfolio is mainly driven by incentive. And that's part of the game. And incentive is the benchmark. With other words, how our portfolio managers are measured? How is an asset management measured? And ultimately, you measured relative to something. And that relative is the benchmark. And we knew everything is basically tailored around that kind of stab. And that's why we knew we only have a real difference if we start moving that benchmark or basically that bar. And then we were kind of busy finding the right benchmark for us. 3 years ago was not easy. It was even much more kind of just in the making. And we looked at different benchmark provider, and ultimately we decided to go with one. And it's a learning, I have to say. Again, changing benchmark, if someone is in the asset management or the financial market industry, that's a big thing, because you change basically the fundament of how is invested and how success is measured. We did it.
You said.
And then the big debate, and I think that's also quickly something which I wanted to share. This is one of the learning. if you switch to an ESG benchmark, you narrow down your universe which you can invest. And of course, this is concentration risk. And that's why it's a bit a trade-off, how much concentration risk you can and want to afford in the portfolio. And then my kind of risk management lens came in. And as a risk manager, you also have to think what concentration is still healthy. Too big of concentration creates, again, enormous downside. And the way how we expressed it, you have an ESG benchmark, you have the ESG ratings, they're quite similar as we know them from the credit rating. And the lowest one is the single C. It's the lowest back of ESG. And we decided, just kind of to give you the example, we decided we invest in respect of benchmark. The lowest one is BB. And again, that means I cut off many kind of constituents, many companies which are below the BB. That means I narrow down the investment universe, which means concentration risk.
Okay.
It's a long-winded answer. Okay. Please,
allow me two more questions, because it's 3 more minutes, and there's, I think, 2 more interesting questions, because you were somehow also excusing that there's many definitions of sustainability, responsible investment. Ed Freeman just said, let 1,000 flowers bloom. Yeah, nobody really has an answer maybe to this question. Do you think it's necessary to have a global standard on responsible investments? Or is it that every investment house can have its own standard and then compete on the market? And as you said, responsibility and profitability are not contradicting each other. It's basically overcoming the old trade-off thinking. Those companies who are best in identifying responsible and sustainable investments will also flower on the market and outperform the others. So I think, can we not also somehow trust the markets that basically in the end sustainability will be forced by market forces?
I think both is true. I think you should leave companies the freedom how to invest and how to express it. Ultimately, it's also finding efficiency, and of course, it's mainly about the reporting. Or if you as a company need to report about ESG and you have completely leeway how you report, it's just not efficient for analysts or for everyone who needs to assess the sustainability. Think about accounting. Or accounting, we have an accounting policy, and basically company need to know how basically they value certain things, or what is allowed to flow through the P&L and what can be basically put up as an asset. And these are certain standards which I think it just makes it easier for company to perform, and you make it much more efficient both for the reporting companies but also for investment. That's why I think a certain standardization is clearly of help to have some framework. On the other hand, you want to give companies the freedom in what they want to invest, and they should prove that they're good investors through selecting the right companies. But I think to make it easier, it's good to have some standardization, and that's why I would say it's both component is correct, but in the area where we can make it simpler, we should do it, because then we are quicker and even more meaningful in respect of bottom line impact.
Last question. Now that ESG investing, sustainable responsible investing is becoming so powerful, more and more people want to invest in a way you described. Are there any or enough responsible investment opportunities? Because of course the investors can say, I want to go in for responsible investments. Are the firms, the companies changing fast enough in order to receive this responsible money? Yeah, so it's basically both sides of the markets. How do you see the investment side? Are there changes to be seen from your side?
I think it's an enormous need of funding. Again, this transition to a more sustainable world, and it's environment is one thing, but we haven't talked about social inequality and ultimate governance. This needs enormous funding. That's why it's not a question that there's no enough opportunity. There's each and every sector has some need to make that transition. Now it's up to us as investors to find the most promising one, basically, who allow to become a more sustainable company. That's why it's not the lack of ESG products, because basically each sector needs a lot of funding, and that's why we need to find the most efficient way to basically finance that huge transition which is required to achieve the 2050 climate goal.
Okay, thank you so much. It was really, I'm happy to hear that the investors are now also on the side of changing the world to the better. And I see this as a very important force in a stakeholder society in order to also think the present from the future and also get the challenges which are ahead done. And thank you for this really very intriguing and interesting talk, and really the time is unfortunately up, but we have time to connect with all the participants here in the platform, and I hope that we have time to exchange ideas this way. Thank you very much, Mr. Fürer.
Big pleasure. Thank you very much. Thank you.
Thank you. Bye.
Bye. Thank you.